Think of the stock market like a rubber band. When you stretch it too far in one direction, it snaps back. Today, we are going to build a 3-step, rules-based trading system to capture those exact snapbacks. We call this mean reversion. To set this up, you only need 3 things: a standard charting platform, a basic understanding of candlesticks, and a stock that is currently trading in a sideways market. By relying on a strict set of rules, we remove the guesswork. You won't have to rely on a gut feeling to tell you if a price is too high or too low. The system will dictate exactly when to act. Step 1 is establishing our baseline. In trading, the mean is simply the average price over a specific time. We will use a 20-period moving average as our anchor point. This diagram shows exactly how price behaves around that anchor. You can see the price zigzagging away from the diagonal mean line, and the red arrows point to the inevitable reversion back to that baseline. This chart graphs the mathematical limits. The dashed lines track 2 standard deviations above and below the mean to measure unsustainable stretches. Crossing the upper boundary enters the sell zone, and dropping below hits the buy zone. By clearly defining these zones, we know exactly where to look for trades. Anything hovering in the middle area is a dead zone, where we have no statistical edge. To see these boundaries on a live chart, you need to apply the Bollinger Bands indicator to your software. This chart shows Bollinger Bands in action. The red moving average is enclosed by outer blue mathematical walls. Green candles hitting the upper resistance circles signal a sell. Red candles dropping to the lower support circle signal a buy. Bollinger Bands do the heavy mathematical lifting for you. They turn abstract statistics into obvious, actionable borders right on your screen. But trading off price boundaries alone is dangerous. Sometimes a price just keeps going. We need a secondary momentum filter, the Relative Strength Index, or RSI. This split chart lines up the price action on top with the RSI oscillator on the bottom. When the RSI line crosses above 70, it's overbought. Dips below 30 are oversold. For a sell signal, red arrows show a price peak exactly as RSI peaks above 70. Conversely, blue arrows show a price valley precisely as RSI dips below 30. Requiring both indicators to agree acts as a strict security checkpoint. If the band is touched but the RSI isn't in an extreme zone, you skip the trade. This chart shows the exact entry moment. Look at the lower black arrow. That long green wick bouncing off the lower band confirms the reversal. Once entered, your profit target is exactly where price meets the middle moving average again. You must also place a strict stop loss. If you buy a stock at 85, targeting a reversion to 95, you place your stop loss at 80. If the setup fails, you take a small, defined loss and move on. This system only works in sideways markets. If you try to catch a falling knife during an aggressive, established downward trend, the price won't snap back. It will simply blow through your boundaries. Knowing exactly when to stay out of the market and using a hard stop loss when you do enter separates systematic risk management from gambling. Let's review the system. You establish the moving average, you box in the price action using Bollinger Bands, and you filter your entries by waiting for RSI extremes. This works because markets naturally seek equilibrium. Just like a physical pendulum swinging to a far extreme, the price is constantly drawn back to its resting position. Your next step is to open your charting software, find a stock in a sideways market, and backtest this specific setup at least 3 times. Executing a verified framework like this consistently builds a professional trading methodology, leaving the gut feelings out of the